Hi, everyone. Um, Good afternoon. My name is Min, and I'm the Director of Investment Research at Endowus. I have with me my colleague Yulin, one of our investment leads. She specializes in fixed income and is lead for our fixed income offerings. We are 2 out of 12 members of the investment office at Endowus. Next slide, please. This is our disclosure slide, and we have to show you this slide. And it's basically just to let you know that the information that we are presenting today is not intended to be relied upon as investment advice. And therefore, the information may not be suitable for all investors. And before you make any investment decisions, please do so with care. Next slide, please. We are taking in questions during the webinar, so please go to this link that you see here, type in the keyword, the password, and just type in any questions that you have for us. And we'll try to answer during the webinar, and one of our colleagues will also help to answer if we're not able to do so. Next slide, please. A lot of people tuning in today are already familiar with us, but I understand that there may be people who are new to Endowus, so this is going to be a very short introduction. We are a digital advisor and platform. Our mission is to give you great advice that's conflict-free. So by that, we mean we don't take any commissions from anybody, the fund managers, the other distributors. We only get paid by you. So if you do well, we do well. So that's what we mean by conflict-free. And we also work very hard and in partnership with our fund managers to give you institutional access to cheaper share classes and world-class funds that may be closed otherwise. Next slide, please. We are backed by some of the most well-known and respected companies in the world, and you can see all their names here: Citibank, UBS, Samsung, etc. Next slide, please. Before we look at the present and perhaps beyond, let's talk about the past and what happened in 2023. There were many significant events that took place last year, and I will just name a few. So starting in the first quarter of 2023, we saw the fall of a number of banks. Firstly, on the west coast of the US, we saw Silicon Valley Bank fail and essentially get acquired. Then we move on to Europe, and there was a takeover of Credit Suisse by UBS. We saw rate hikes and then pauses in those hikes. We saw the boom in AI and the rise of the big tech companies again. And of course, ongoing geopolitical tension and conflicts with Ukraine-Russia war still continuing and Israel-Hamas conflict as well. So how did the markets do with all this volatility? Next slide, please. Quite well, actually, with the exception of the index right here, MSCI China and commodities, which is represented by S&P GSCI. The markets, the other markets and asset classes all had a pretty fruitful fourth quarter and an even better 2023. These returns that you see on the slide are all in USD terms. The US had a very strong year as represented by the S&P 500, and Europe, although it's not represented here on this chart, did very well along with Japan. So for the Japanese equity market, if you think about it in yen terms, it did even better. It returned about 28%, but gave some back because when we convert to the US dollar, so the returns were lower. 2023 was a difficult year for the Chinese equity market. And that we can see that was probably some of the lingering effects from the property crisis and some other aspects from the COVID restrictions. And even though the GDP growth for 2023 was really respectable, around 5%, I think investors were still a bit concerned. Next slide, please. In terms of factors, and by factors, we mean small value, profitability, etc., we saw that growth companies continued to dominate value companies, both in the fourth quarter and in the one-year period. This trend was consistent in both the developed and emerging markets. As for the size factor, while large cap companies in the developed markets outperformed against the small cap companies, the reverse was actually true in emerging markets, as EM small caps beat EM large caps by about 13% in 2023. Next slide, please. This is a very colorful slide. Personally, I really like the color scheme. After a terrible 2022, and we saw the Magnificent Seven stocks listed here: Apple, Amazon, Google or Alphabet, Meta or Facebook, Microsoft, Nvidia, and Tesla. They declined by about 46% on average. 2023, huge rebound, average of 111% from these 7 stocks. And then you contrast that to the S&P 500, which delivered 26%, and the Nasdaq 100, which delivered 55%. And you can see why, anybody that you talk to were feeling a bit of FOMO that they hadn't invested all of their wealth into these 7 stocks. But while this is all very good, what you can see last year's return is so attractive, it's important to remember that these stocks are also very volatile. I think very few people, including myself, would have the ability to hold these stocks through the major ups and downs. For example, Meta returned 194% last year, but fell more than 75% from its peak. And over the last 3 years, it only returned 9%, which is actually less than the benchmark indices. And with that, I will hand you over to Yulin for a review of the fixed income markets. Over to you, Yulin.
Thank you, Ming. Next slide, please. Yeah, so just to rewind back to 2023 and taking a look at the fixed income market, investors entered 2023 with very high expectations for the fixed income market, but it didn't quite deliver until the big turn in the last 2 months of the year. In Q4 last year, during the Fed's last policy meeting of 2023, they finally delivered a pivot. And market quickly moved to price in future rate cuts, and this propped up fixed income return broadly, especially in longer duration assets, such as global investment grade bonds and global inflation-linked bonds. Global economy was slowing but continued to show resilience, especially in the US. So even credit spread tightened further in Q4 2023, rewarding risky assets. And it was under this background that we saw fixed income markets rally in Q4, and some people famously said it's a pivot party. Sectors with higher credit exposure and duration exposure gained. So, for example, emerging markets debt, especially local currency market, led the way. And this was followed by global investment grade and inflation-linked bonds. High yield market lagged in Q4, but because of its shorter duration, but it ended the year being the best performing fixed income asset class. Despite record inflow into cash and money market products in 2023, fixed income assets ended the year mostly beating cash, and in many cases by a very wide margin. Next slide. Now let's zoom back to a 2023 overview, especially examining one key driving factor of the fixed income market, and that is interest rate. The key message I want to deliver here to you is that it is extremely difficult to time the market and the macro environment as an average investor. This message comes especially loud and clear when we do a post-mortem of the market and just see how many surprises it has delivered in just 1 year. So this chart shows the evolution of US short-term and long-term yields from the beginning of 2023 to the last week of January 2024. Going through the rates market in last year was like riding a roller coaster with 3 broad episodes. In the first quarter, the market experienced the early worry of the US debt ceiling, driving yield up. And this was followed by a blow up in a few US regional banks, like Ming has mentioned, including Silicon Valley Bank. So recession fear came back in picture, driving yields down massively, especially on the shorter end. In an environment where bad news is good news for the fixed income market, most fixed income assets, in particular long duration ones, performed very well. And not a bad Q1 for fixed income market. And maybe some investors would have thought a broader crisis was coming, Fed needed to pivot soon. Well, not yet. The second and third quarter proved to be a rather slow bleed for fixed income. The higher for longer narrative dominated. Fed proceeded with two more 25 basis point increase in the rate in May and July, bringing the effective Fed rate to the range of 5.25 to 5.5%. And coming to Q4, fixed income markets rallied euphorically after signs of Fed pausing and pivoting in the near future. Yields came down drastically before giving back a little in January this year. Despite the year-end rally, the fixed income yields still remain elevated versus historical level. So JP Morgan summarized 40 notable events that helped shape markets in 2023. Both equities and fixed income markets have defied many people's expectations many times last year, and both outperformed cash in the end. As I said, it is extremely difficult for an average investor to predict and outperform the market in the short term. So that is enough on the market look back. And now I will hand over the time to Min to discuss how the Endowus Hong Kong model portfolios have performed in the Q4 and 2023 last year.
Thank you, Yulin. Can we go to the next slide, please? So before we discuss the performance, just a quick recap of what the Endowus Global Model Portfolios are. They are actually a series of portfolios consisting of equity and fixed income funds. And we designed them to make up the backbone of an investor's overall investment strategies. And they can be tailored to your particular risk tolerance and return expectations. So all the way from very aggressive to very conservative. And with that, in terms of performance, the model portfolios displayed strong returns in the last quarter of 2023, similar to the broad equity and fixed income indices. The 100% equity portfolio, and by that I mean the very aggressive portfolio, underperformed its benchmark, the MSCI equity, slightly in Q4. And this is largely due to its structural overweight in the emerging markets. As we saw in the earlier slides, the emerging markets underperformed the developed markets. So this underweight was actually a detractor. On the other hand, the 100% fixed income portfolio, by that we mean the very conservative portfolio, outperformed the benchmark, the Bloomberg Global Aggregate Index, by about 0.5% or 50 basis points in Q4 and about 1.5% in 2023. And this was really because the portfolio was overweight in terms of slightly overweight in terms of EM debt. And all the funds in the fixed income sleeve outperformed the global ag on a one-year basis and therefore contributed to the outperformance. Next slide, please. These are the CashUp portfolios, and these portfolios are designed for short-term cash management. They are built using high-quality money market funds and or ultra-short duration bond funds. So as we move to the end of 2023, we saw that the CashUp portfolios, both of them, Simple and Plus, continue to deliver positive returns on a year-to-date basis or one-year period. CashUp Simple returned 5.26%, while CashUp Plus returned 5.46%. CashUp Plus has the flexibility to add to duration, which means that it can allocate to longer duration securities or basically longer maturity bonds. Or even though they're still very short in terms of duration, they're still longer than what a standard money market fund may buy. And that can offer higher return potential in exchange for higher interest rate risk. Just a reminder, though, that while CashUp Plus underlying funds are money market funds and ultra-short duration bond funds, CashUp Simple is constructed with just high-quality, more conservative money market funds. And with that, Yulin will take us through the rest of the model portfolios. Over to you, Yulin.
Thank you, Ming. So I will go through the passive income model portfolios first. Can we go to the next slide, please? And just a recap of what passive income model portfolios are for. They are model portfolios designed to meet different investors' passive income and growth needs. So we have three different passive income portfolios. Steady is a conservative 100% fixed income model portfolio that targets to offer stable and dependable monthly payouts with capital preservation as the secondary objective. And current target payout for the steady passive income portfolio is 5 to 6% per annum. And Passive Income Plus is a relatively aggressive fixed income portfolio focused on delivering a high level of monthly payouts. The portfolio has meaningful exposure to high yield bonds, hence it takes a higher credit risk than the steady income portfolio. And currently, its current target payout is 6.5 to 7.5% per annum. Lastly, passive income growth is a measured multi-asset portfolio with a dual objective of delivering monthly payouts and long-term capital growth through exposure to both fixed income, dividend equities, and accumulating equities. Its current target payout is 4 to 5% per annum, and in the long term, it also targets to deliver some kind of capital appreciation. So in the last quarter of 2023, the passive income, steady and plus model portfolios both delivered a 5.9% positive return, aligning with the Bloomberg Global Aggregate Index. Their performance was influenced by a mix of shorter duration positioning, which is a detractor in terms of relative performance since duration actually rallied. But its higher credit exposure added to performance because of the tightening of credit spread. And especially for the plus portfolio, it benefited from its exposure to high yield bonds. And the passive income growth portfolio saw a 7.3% return, but underperformed its 40/60 benchmark due to its shorter duration in fixed income, as well as an overweight in emerging markets equities and Asian equities, affecting its equity component. Next slide, please. So we also have a range of satellite model portfolios, and the purpose of a satellite position is for clients to express your views, convictions, and preferences on very particular segments or trends of the market. It is not meant to be a dominant position in one's overall portfolio, but it's meant to complement a globally diversified core portfolio that should make up the majority of an investor's portfolio. So I'll go through each portfolio's performance one by one, starting with the China equities portfolio. Q4 presented a lot of challenges for China, marked by, for example, renewed regulatory concerns and disappointing manufacturing reports. In the Greater China region, Taiwan's stock market showcased more favorable returns, boosted by the Fed's dovish sentiments that revived investors' confidence in growth and technology-related sectors. Conversely, Hong Kong stocks faced greater pressure, and it actually concluded the year as one of the world's worst performing stock markets. So this challenging environment influenced the performance of the China equity portfolio, which struggled against all these market headwinds throughout the year. The portfolio exposure to Taiwanese equities had provided a buoy in the later part of 2023, but it was insufficient to pull the portfolio out of the water. And moving on to the sustainability equities model portfolio, it posted strong returns in Q4, although it trailed the benchmark MSCI Equity Index slightly. It's underweight in the US, compounded by an overweight to emerging markets versus the benchmark, were the primary detractors of the relative performance from an asset allocation perspective. And moving on to the technology portfolio, actually, I'll talk about future trends first, since this is further up in the table. So future trends portfolio saw a strong 9.5% Q4 gain. And again, this was really supported by a dovish Fed and strong performance in specific funds, despite it underperforming the MSCI Equity Index on a full year basis. However, its underperformance in 2023 against the equity can be attributed to strategic choices in stock selection away from the Magnificent Seven and some short-term macro headwinds in a few sectors and specific fund challenges. And this highlights the portfolio's focus on long-term secular trends over immediate market leaders. And lastly, for tech portfolio, it had a strong Q4 performance, outperforming the MSCI Equity Index. And this was driven by the dovish monetary policy shift, which particularly benefited smaller and growth-focused equities. The portfolio, however, underperformed the MSCI Equity IT Index, and that was due to lesser exposure to the Magnificent Seven stocks. Because the portfolio focuses instead on diverse high potential companies. And these smaller names previously facing challenges actually showcased significant gains in Q4, illustrating the portfolio's strategic emphasis on uncovering alpha opportunities beyond the market's leading giants. So that concludes the performance review section, and we will move on to examine a few major themes looking forward that might or might not impact the market in 2024. Next slide, please. Next slide. So first, going back to a very important thing that shifts the market, and that is the monetary policy. Following the 11 hikes in the past 2 years, we might finally see a downward trajectory in interest rate. According to the Federal Open Market Committee's latest projection in December, the median expectation is for 3 quarter-point reductions of the Fed funds rate in 2024. Market expectations, however, can differ from the Federal Open Market Committees, with markets having priced in 4 to 6 cuts at various points since December, and these expectations are always evolving. The reality is the timing and the extent of rate cut will depend on 2 key factors, inflation and growth. So inflation has moderated to 3.4%, a rather encouraging sign. However, if reducing the last bit of inflation proves more challenging than expected, the Fed's ability to cut more aggressively and early would be limited. And actually, according to the latest Fed meeting on the last 2 days of January, it does seem like the Fed requires greater confidence that inflation is moving sustainably towards the 2% target before they expect it to be appropriate to cut rates. Similarly, the nature of economic lending, whether it's a no landing or soft landing or recession, is a matter of debate. Market consensus fluctuates between all these scenarios, and if the economy is weaker than expected, the Fed might also need to cut rates more aggressively and sooner. But does the exact trajectory of interest rate cuts matter significantly for the intermediate term investors? I would argue no. The real question investors should be asking is about their asset allocation. For instance, are you over allocated to cash? Is cash still king? When interest rates drop, the return on cash will immediately decrease as well. Are you prepared for this reinvestment risk? Next slide, please. So continuing on the topic of whether cash is still king, the provided chart shows the return of global equities, fixed income, and cash 1 year after the end of historical rate hiking cycles. In most instances, both equities and fixed income outperform cash, with fixed income offering more certainty. However, each period, of course, has its own dynamics and trajectory. For example, from 1995 to 1996, it was a higher for longer period, with the Fed maintaining high rates for multiple years. And in that environment, fixed income marginally outperformed cash. In 2000 to 2001, during the immediate rate cut due to the struggling economy and the tech bubble burst, equities suffered, but fixed income delivered stellar returns, outperforming cash by 5% in that year. So these are just some food for thoughts for investors, and I will pass it to Ming to cover geopolitics and artificial intelligence.
Thank you, Yulin. Great stuff. I think I learned a lot from you. So geopolitical tension, and what the slide is showing, is actually, I'm sure, on everyone's mind as we come to 2024. Will there be a continuation of all the volatility that we're seeing in geopolitics from 2023? So conflicts such as Russia, Ukraine war, Israel-Hamas conflict, they all have far-reaching consequences. It's difficult for the participants, the people involved. It's difficult for the communities. It's difficult in terms of supply, demand, supply chains. There's long-lasting impact when it comes to humanitarian and social aspects. But then, not to minimize, or to trivialize war, but the impact of the war in the markets tends to be minimal according to this chart. So you can see that there are all these different historical wars and the returns from each of these major asset classes. So there's large caps, small caps, and long-term bonds. And there are only two periods where small caps actually had negative returns, and that was during the Gulf War. And for long-term bonds, it was one period where it declined, and that was during the Korean War. So other than that, the markets have been positive. And the other thing to note is that in terms of lasting impact, we see that the length of time needed for recovery is actually really short. So if you look at the last table, which is the all geopolitical events, it's 47 days to recovery. So that's even shorter than just 2 months. So while it looks like it might be really difficult, if you could just stay invested, you'll start to see recovery eventually whenever there's volatility. Next slide, please. Okay, this one, really, it's just what's been going on also in terms of the latest trends, the mega trends, which is ChatGPT and AI. I found this table and timeline really interesting, so I thought maybe we can talk about this. It's all divided into 4 different stages or phases of AI. From 1950 to 1980, we can call it the foundations and early innovations of AI. So during this period, AI was actually in its infancy. And this is when foundational theories were being developed. And the focus was on creating systems that could mimic certain aspects of human intelligence. So it's still very, very early. In 1950, Alan Turing introduced the Turing test, which set the stage for AI. And then in 1956, the term artificial intelligence was coined. So this is the formal start of AI as a research field. And then you come to the next phase, which is the green, the green color phase. And this is when really you see the rise of machine learning. There's a shift towards machine learning, moving away from rules-based systems that was prevalent in the earlier stages. And in this era, AI and NLP, or natural language processing, began to evolve more rapidly. And this is really because of the advent of machine learning and the digital data that you're getting from the rise in internet. The other significant event, which I found interesting, was in 1997, probably a period when some of you might not have been born yet. There was a significant milestone in AI. IBM's computer, this like the most sophisticated computer back then for IBM, called Deep Blue, defeated world chess champion Garry Kasparov. So this was quite a big deal because it was a machine actually defeating a human in a game of chess. So in those days, it's a big deal. But now probably AI will defeat everybody. Then we go on to the next phase, which is the blue, and we call it the 2000s. So this is when big data really came into more usage by everybody. The term deep learning was coined and described algorithms that enabled AI to learn from large amounts of data. This is also when we started seeing speech recognition and translation services. So from 2010s, that was when the major breakthroughs occurred. IBM again, this wonderful team came up with Watson, another very powerful computer that won Jeopardy, a game show, and that showcased how advanced NLP had become. And of course, going on to 2010s, we started to see AI creep into daily life through the virtual assistants such as Siri, Alexa, and Google Assistant that has no name. And in 2020s, the age of ChatGPT, where we are now. In 2020, OpenAI introduced ChatGPT, which is a variant of GPT model, which stands for Generative Pre-trained Transformer. I don't really know what that means, but that's what it means. So it revolutionized the way AI understands and generates human language. And I'm sure a lot of you have actually used ChatGPT. It's able to create answers that are like in a conversation format, create content, create art. So it's all very, very sophisticated. And it's probably going to be one of the most defining tools, I believe, of the 2020s. And next slide, please. I found this chart really interesting too, because it just shows how quickly humans have actually come to adopt new technology. So here you see on this chart, Netflix. It took them more than a few years to actually reach 1 million users. Facebook, slightly less than a year, 300 days. Instagram, I think it says 75 days, so less than 3 months. And of course, ChatGPT took only 5 days to reach 1 million users. That's less than a week. So just imagine how powerful it must be for so many people to want to start using this technology. For those who haven't started using ChatGPT, I can tell you that it can create extremely professional email with perfect grammar. It can offer questions. It can answer questions from clients, and it can also analyze market trends and generate insights to help you make crucial decisions. So this integration of AI into daily life has really expanded the realm of creativity for humans. And next slide, please. So apart from the impact on our everyday lives, how is AI going to affect us? I think for some people, they're worried about their jobs. So the chart on the left that you see shows that most jobs in advanced economies are exposed to AI. So they're most vulnerable to AI in a way. And the emerging markets and the lower income countries tend to see less of that impact. And that's mostly because a lot of it is still kind of physical in nature. With this, it means that those higher income jobs that can complement AI, or AI can complement these higher income jobs, the productivity would increase and the efficiency would also increase. So if you're able to really utilize and take on AI as a tool to help you in your job, you're likely to get better at it and likely to be paid more in the long run. So some economists are worried that this may lead to a disproportionate increase in terms of disparity in income in different countries. So these two charts are from the IMF, so I'm not surprised that they would think that. On the chart on the right shows how prepared each group of countries is relative to how vulnerable they are to AI. So you see that the advanced economies are the red dots on the far right. They are probably most exposed to AI, but also the most prepared to tackle this challenge. And while this looks like it might be a while away, it's actually not. We personally feel that AI is here. This is not a crystal ball reading by me or by Endowus, but we should expect to see more of this being played out this year. And while anything AI related in the markets would continue to be chased by investors, such as the Magnificent Seven stocks, we should remind ourselves that there is massive volatility associated with just doing that, and that most, if not all, industries and sectors should expect to benefit from AI, and it's not just isolated to the tech industry and sector. Next slide, please. Just going to end off my section here with this slide. I feel it's a very powerful slide, even though it's very simple. You can choose what you want to do with your money. You can choose to spend it. You can choose to save it, put it in a bank account. You can use it to speculate, but with high returns come very high risks, as you can see, and the churning and the commissions that you pay while you're trading may also eat away your profits. And of course, at Endowus, we believe that investing in a long-term manner with your eyes very trained on the long-term goal, the end goal, that would be the best way to accumulate wealth. Next slide, please. And now we come to the Q&A section. I don't know, maybe Yulin, are you ready to maybe start off with a question or two?
Yeah, sounds good. I will just start in sequence of the most upvoted question. Yeah, so on Slido, there are 3 votes for this question. Is there still a place for active management of equities, considering most active equities managers underperform passive ETFs/index funds? I have one immediate thought, and that is the Warren Buffett quotation. Only when the tide goes out do you discover who's been swimming naked. And I'm wondering whether we are entering such a period when the economy might finally go into a slowdown mode, and companies would have bigger differentiation when it comes to survival and growth. And if an active manager could identify, what kind of companies would actually weather through the upcoming downturn better, then they could finally, deliver some alpha. I think it's really difficult when generally the economy has been very accommodative and interest rates has been going down, to differentiate between the real alpha and just, potentially just loading on the market and getting that upside beta, overloading on beta. Yeah, any thoughts from you, Ming, to add on to this?
Yeah, so I totally agree with you, Yulin, on what you said, and also on I think the Warren Buffett's quote is really powerful as well to illustrate this point. And the other thing too is that we often see passive or index tracking funds are good ways and cost-efficient ways to gain exposure to efficient parts of the market. But the market is there are still some pockets of inefficiency. So in those segments, perhaps active management might still work very well.
Yeah, that's right. Especially, okay, I think this person is pretty clear it's in equities, because in fixed income, when the market is very inefficient, it's very clear that active management does work. The next question on slide, I'll just read it out. Okay, if SPY, VOO, and for those who are not familiar with these 2 ETFs, those are the ETFs tracking the US, I think it's S&P 500 index. So this person asking if these 2 ETFs tracking the US market are yielding better results than even the very aggressive portfolio, what are the advantages of purchasing the funds curated by Endowus? I mean, do you want to start? And I can add on if I have any further thoughts.
Yeah, sure. So this is actually essentially asking if investing in the US market alone is better than investing in a globally diversified portfolio, because the very aggressive portfolio, or the 100% equity portfolio that we offer on Endowus, is made up of all the different countries and not just tracking the S&P 500. It seems, because I think a lot of people, when they look at returns, they really just focus on the last few years of returns. And it's true that the US market has been the strongest market by far compared to a single, other single country markets. But if you go back further out, you will see that there has been times when it has underperformed the rest of the world. So if you just take a longer, if you just go back longer in history, I think it makes sense to invest in something that's more diversified, so that if the US underperforms, if you're just investing, a portion of your portfolio in the US, you would have had a smaller drawdown compared to just investing in the US market alone. And of course, the other thing is, are we sure that the US would continue to outperform the rest of the world? I don't know the answer to that question, and I don't think many people do. So maybe Yulin, you can add more to it.
Yeah, I think just to add a bit more context on the relative performance of US market against the rest of the world, I think we always have a recency bias, like Ming mentioned, and it is true that from post-financial crisis, US has been the best performing stock market compared to the other markets. But actually, that was not true if you look at the previous decade, post the tech bubble until the end of 2010, the global financial period. Basically, if you have put all your money in the US stock market, you would have gained nothing for that 10-year period. Whereas the emerging markets went through its golden period for that decade, and I think it doubled its market value just over that 10 years. So, yeah, I mean, personally, I think if you really have conviction that US is going to be the best for the next many years to come, you can go for the passive exposure to the US stock market. But I think here at Endowus, we believe that it is very difficult to predict which market will do the best. And a more prudent way of managing and growing your wealth is actually through a globally diversified portfolio. And another point, and I think this also links to another question that I am seeing, and that is, can you explain why investing with Endowus is better? I can just do ETF for free. So it comes back to the value proposition of Endowus. And I think at the core, we are a digital financial advisor for you, for everyone. And just to take a step back, I think investing is fundamentally about achieving your long-term goals. So it has to start by being goal-based. It's not about just going into the market trying to make short-term gains, but it's about understanding your long-term goals, your risk, and then planning out your investing accordingly. And this is essentially what we are here to try to help you to achieve, with a very diverse range of offerings, from not just passive, which is primarily what ETFs offer, from passive investing to factor-based investing to active investing, and not just for equities but also for fixed income, because you need to figure out the asset allocation that actually suits your different investment objectives and time horizon. So so I think that is really the real value that we offer. And sure, ETF is very cheap, but it still has transaction cost every time that you trade. And I think there are still some tax implications, but of course it depends on where you are domiciled. Yeah, anything else for you to add here, Ming?
No, I think you answered the question well, so I don't have anything else to add. There is one question that I would like to address. That is, there's actually a question on income portfolios, but I'm going to leave that for Yulin, who's a fixed income expert. So I'll address the question on how much of my portfolio should be in equities, given the volatility of today's global markets. This really comes down to your risk tolerance. Before you start investing, you should think about how much are you willing to accept in terms of drawdown? How much are you willing to risk? And I think this is, as long as you're clear on what your risk tolerance is, that's how much you can put into equities, because equities are generally more volatile than fixed income. They're definitely riskier. But whether it's more volatile today or tomorrow should not really be the deciding factor of what you should be investing in. It's rather the risk tolerance. So what you can live with, that should be what is most important. So because even if volatility is high, some people would say that this is perhaps the best time to buy when everybody's afraid of the markets, when everybody's living in fear. This is when you should go in and buy, and because it's cheap. Maybe then I'll turn it back to Yulin to answer the question on income.
Yeah, what percentage of portfolio should I allocate into income funds? I think it's actually really a math question. Firstly, I think I assume you're buying income funds because you need income. So maybe you have a mortgage to pay, maybe you have some, I don't know, interest hobbies that you want to fund with this passive income. And depending on that, and depending on your principal amount, like the amount of assets you're willing to invest, then you can figure out what's the percentage payout you would like to get, and it and take a look at the descriptions and the articles that we have written on the income portfolios and the income funds to understand it and see whether that actually suits your risk tolerance. But essentially, you just need to figure out how much cash you actually need and how much payouts corresponds to your risk tolerance. So the higher payout generally correspond to a higher risk that you are taking. And then you can figure out, oh, then I need to put in this amount of money in order to get to the cash payout that I would need to fulfill whatever real needs I have in my life. And if you have any questions on that, you can always reach out to our client advisor at Endowus, and they can walk through this process with you to really think it through.
Thanks, Yulin. There's a question that I would like to address too, which is, do you make bad investment decisions because of emotions? And if so, what can we do to prevent that but still get returns? Yeah, that's a really good question because human beings in general are emotional, and we do make bad decisions, whether if it's just investment related or otherwise, because of emotions. But what we can do is, first of all, I think this is also related to the other question that I answered earlier. You need to first know what your risk tolerance is. Are you a risk-seeking person? Are you okay with, getting investment returns of 20% and then down 20% the next year? If so, then you're probably risk-seeking. But if you prefer to just have steady returns of 6%, occasionally see some drawdowns, then that means you're not as risk tolerant and you should be having more in fixed income or something that's more conservative. So once you've decided that that is what you can take in terms of volatility, then I think that will really guide to help you in making the rest of the allocation decisions for your portfolio. And the thing is to stay invested. So even though it looks really scary, the market is going down during COVID, 2022, we saw everything go down. If you had stayed invested, you would have realized the upside that 2023 was. So it's just a matter of staying disciplined in being invested throughout bad times and good times. And I think if you have additional questions or need help assessing your risk tolerance, please feel free to reach out to our client advisory team. They're always here 24/7, maybe not 24/7, but here almost all the time to help you with your questions. Yulin, you want to take the next question?
Yeah, just looking through the questions. I realized that, there is a very specific question that came in. The majority of my assets are currently in the global portfolio, very aggressive, and I am 25 years old. Should I do fixed income, etc.? Given my risk appetite is high. All right. Actually, if how should I do it? There's kind of a juxtaposition in this question itself. I think the assumption is that if your risk appetite is high, you are thinking about allocating a bit from equities to fixed income. So maybe we can explain first the risk spectrum of different asset classes. Fixed income is on the more conservative side. And of course, within fixed income, there is a spectrum of risk from your really kind of safe government bonds to the more aggressive high yield bonds. And after that, it is equities. So on a relative scale, equities are definitely more aggressive, riskier than fixed income. And as a 25-year-old, you do have a lot of time actually to weather through the volatility over time if you don't need this amount of money, let's say for the next 10, 20, 30 years. Then I think you made a very good decision of going for the very aggressive portfolio, which would hopefully reward you with the highest return as well within the spectrum of risk. There's no free lunch, right? The higher risk, the higher return. But actually, if looking back, you think, oh, the historical volatility of this portfolio has been a bit too high for me because we have gone through quite a volatile period, not last year, but maybe the year before 2020, and you think I'm not super comfortable with it, that probably means your risk tolerance is a bit lower than what you have thought. And then it's worth considering adding a bit of fixed income to lower your risk. It's not there to increase your risk. If that makes sense to you. I hope this answers your question. And if you have any more questions, yeah, feel free to write in or call in to our client advisor team.
And it looks like we've answered most of the questions actually, because some of the other questions are actually have been addressed through the webinar content, like some of the themes that we should be looking at for this year, the reason for the underperformance or outperformance, talking about the Fed pivot. I believe we've answered most of the questions. Anything else you'd like to add, Yulin?
No. Yeah, I think there's actually quite a few kind of, what are the themes we should be looking out for. It sounds a little bit more forecasting and tactical. And I think just to go back to the core, we are really, really bad. Like all of us are really bad predictors, and most of us gets our prediction wrong. So I think the focus really is on staying invested, being diversified, being long-term, and aligning your portfolio to your investment goals. And constantly going back to your existing portfolio and assessing whether the asset allocation is still suitable, right? For example, I have mentioned during my section of presentation, I think a lot of people are probably over allocated to cash right now, because the cash yield was actually very attractive. And indeed, it was a year of cash in 2022, for example, when all the other asset classes were down. But is it really still suitable for you if you are investing the assets for the next 5-10 years to stay in cash, knowing that the cash rate will probably come down, right? So I think these are just some things for you to go back, reflect and think about. And hopefully, we're always here to help you to think through these issues. Very, very important decisions to steward your wealth for the long term.
Very well said. Thank you so much, everybody, for tuning in during your lunch hour. And also thank you for your support. That's it. Bye.
Thank you.